Welcome to the perfect video for you as a complete beginner when it comes to selling covered calls in your portfolio. This video has the potential to help you generate tens of thousands of dollars in cash flow. Want to retire early? Pay for your mortgage with your investment portfolio. All of this is at your fingertips and it all starts right now. So what exactly is a covered call? There are two components to a covered call which we will detail fully in this video. The first is the stock or the ETF that you own. This could be a dividend stock, it could be a growth stock, or an ETF like the S&P 500, ticker symbol SPY. The second component of a covered call is a call option that you sell on the same investment that you own. Now this leads to, I think, a very natural follow-up question, which is, what exactly is a call option? Let's start with a very straightforward definition. A call option is a contract. When you hear contract, think bet. A call option contract involves two parties just like a bet. In the case of selling covered calls, there is an option seller and then an option buyer. The option seller is selling a contract that obligates them to sell 100 shares to the option buyer for a specific price within a specific time frame. Now, to better help us understand this contract or bet, let's think about a few non-investing examples. Playing a carnival game at the fair and buying insurance for your vehicle. Now, when you get accosted at the fair to play a carnival game, you are required to pay to play. If you want to play the game and potentially earn a prize, it's going to cost you money. And no matter what happens in the game, they're going to keep that initial cost. By paying that money though, the carnival game attendant is obligating themselves to give you a prize if you happen to win. That is, if you win. And we all know those games are rigged. What about buying insurance for your car? You buy insurance by paying money to the insurance company. You don't ever get a refund of that money. You are buying peace of mind, and that payment to the insurance company obligates them to provide financial compensation to you if certain things happen, such as injuries or damage from a car accident. In both of these scenarios, the option seller is the carnival game and the insurance company. So let's bring it back to selling covered calls. As the option seller, you are selling a contract that is obligating you to potentially sell 100 shares of a stock if a certain situation occurs. Let's take a look at an example. ExxonMobil Corporation, ticker symbol XOM, is currently priced at $108.43 per share. As the option seller, I own 100 shares of XOM already, and I think the price of XOM will not be above $112 per share in the next 8 days. Therefore, I sell a covered call. Now it's covered because I already own the shares, but more on that in a little bit. I sell a covered call with a strike price of $112 and expiring on June 16th, 2023 for $46 in premium. Now let's use this example to identify some of the common terms. Number one, strike price. This is the price at which you are obligated to sell 100 shares to the option buyer. If at expiration the price of the stock is above this strike price, even just by 1 cent, then you will have to sell 100 shares at $112 per share. Secondly, expiration date. This is the ending date of the contract and the moment when your obligation to sell 100 shares ends. If at the end of trading on expiration day, the price of the stock is below the option strike price, then the option contract will expire worthless and your obligation will end. Term number three, option premium. This is the money you earn as the option seller when you sell the contract. You earn this money in exchange for selling the contract and creating the obligation to sell 100 shares in the future. Here are three additional terms you need to know about. Number one, at the money, and then in the money, and out of the money. These terms are related to where the stock price is in comparison to your option strike price. So going back to our ExxonMobil example, if the stock price was $108 per share, if the current market price for the stock is below our option strike price, then our option is known to be out of the money or above the current market price. On the flip side, if the stock price has risen above our strike price, then the option is in the money. And if the stock price is exactly at or right around the strike price, that would be at the money. So going back to our ExxonMobil example, we have now sold an option contract for XOM at the $112 strike price expiring June 16th, 2023. in exchange for $46 of option premium. Now at this point, one of two scenarios are going to occur, but regardless of which one occurs, you as the option seller get to keep all $46 of the option premium that was given to you when you sold the contract. Scenario number 1. At the end of 8 days, the price of XOM is below $112 per share, which is the strike price. If this occurs, the option contract will expire worthless. You get to keep your 100 shares and you keep the $46 option premium. Scenario number 2. At the end of 8 days, the price of XOM is above $112 per share. If this occurs, the contract will be assigned, meaning the obligation will be enforced and you will have to sell 100 shares of XOM to the option buyer for $112 per share. Remember though, you already own 100 shares of XOM. So in this scenario, you simply sell your 100 shares to the option buyer. And again, you still get to keep that $46 in option premium. Now, this is the perfect time to explain why we call them covered calls. In this scenario, since you already owned the shares of XOM, you didn't have to go and buy 100 shares of XOM and then immediately sell them to the option buyer. If you think about it though, this would be a very risky bet to make. What if you didn't own 100 shares of XOM, but you were still under the obligation to sell 100 shares at that specific price? $112 per share. What if the stock price for XOM rose significantly during that time frame prior to expiration? What if OPEC cuts supply and the price of XOM zooms up to $125 per share at expiration? Well, the option contract would be assigned and you would need to sell 100 shares for $112 per share. But you don't own 100 shares. So you have to go buy 100 shares at the current market price. $125 times 100 shares equals $12,500. And then immediately sell those shares for $112 times 100 equals $11,200. That is an immediate and very real $1,300 loss. Now this risk is actually unlimited because in theory, there's no cap for the price of XOM. In theory, it could go up to $125, $130, $150, $250. Who knows what could happen in the future? This would be catastrophic for you. But because you already own 100 shares of XOM, your risk is locked in based on what you paid for your shares. This is what makes it a covered call. Your risk is covered and you are immune to the current market price of XOM. This also means that as long as you sell covered calls at a strike price above your cost basis, you cannot lose money with this strategy. The only additional risk you take on with this strategy is opportunity risk. This means that there could be situations where you make money, but not quite as much money as you would have if you hadn't sold the covered call. To explain this, let's go back to our XOM example. In this scenario, let's say at expiration the price is $114 per share. Here's what would happen. The option contract would get assigned and you would be obligated to sell 100 shares of XOM at $112 per share. When you sell the shares, you would receive $112 times 100 shares equals $11,200. If you subtract what you paid for the shares, $108 times 100 equals $10,800, this means the capital appreciation is $400, and then you add in the additional option premium you received of $46. In this scenario, you made a profit, but you missed out on some of the capital appreciation. If you had not sold the covered call, but instead sold your shares on the same day, you would have received $114 times 100 shares equals $11,400 minus your cost basis, $10,800, equals a profit of $600. The difference between $600 and $446 is not a loss, but it is the opportunity you missed out on. Okay, now that we have a basic understanding of how the covered call works, let's take a look at the option chain for XOM. The option chain is akin to a marketplace. This is where you go to buy and sell options for a specific investment. We are specifically looking at the Fidelity brokerage platform version of this option chain, but you should know that most brokerages offer something very similar. Here are the different expiration dates. Here are the different strike prices you can choose from. The left side of the option chain is for call options, and the right side of the option chain is for put options. We're going to keep the conversation though focused on call options at this time. Now remember, this is an option marketplace, and the market price for different options is constantly changing. So how do we know what the current market price is for an option contract? We need to look at the bid and the ask. The bid is currently the highest price an option buyer is willing to pay for an option contract. And the ask is currently the lowest price an option seller is willing to sell a contract. You will notice that these figures in the bid and ask are small numbers. That's because these prices are based on one share of the stock. To calculate the actual option premium you would receive as an option seller, you would multiply that number by 100 shares, because remember, option contracts are always for 100 shares at a time. If you want to sell 2 contracts, you must have at least 200 shares. So let's scroll down here and look at the June 16th expiration, which is in 8 days. If you wanted to sell a contract, let's say for the $112 strike price, we would come down here to 112 and come across here and click on this number right here. See how it says sell to open? This is the order form. I would put in quantity, let's say 1, and then it'll tell you here's the bid, here's the ask, and here is right in between the bid and the ask. You would put in here the limit price. It's critically important here, you should always be using a limit price, meaning that the contract will not be sold unless you get this price. If you do a market price, then the order is going to immediately execute at whatever the current price is. It's always better to do a limit order. And let's say we want to go right in between. We'll just go with 39 cents right here. So 39 cents times 100 equals $39. And they're subtracting out a fee of 65 cents. Then you would click preview order, and then you would place the order if you wanted to. This order might be filled right away, or you may have to wait for the market price to come up so that the option price is actually filled at the price you want it to be filled at. Now, once you sell the covered call, you can come in here to your portfolio view. You can see your option contract. You'll notice here that I have covered calls actively on Bank of America right now, Best Buy, Colgate-Palmolive, HP Incorporated, and others. You have the stock that you own, and then you have the call option. And then you'll notice here, this is the current value of the option, which is always constantly changing. Now, to this point, we've only talked about what would happen to a covered call option contract at expiration. But the truth of the matter is, we have the ability as the option seller to close our position early. To do this, you would need to buy the option back. Now, I can appreciate that's a little bit of a confusing statement. Remember, at the beginning, we started by selling a new covered call to open a new position, or sell to open. In order to close our option, we need to do the exact opposite, which is buy to close. You can do this at any time. However, you will have to pay whatever the market price is for the option. That price may be higher or lower than what you initially sold the option for. So now's an appropriate time to answer the question, how are option prices determined? The value of an option contract at any time can be determined by 2 things: the intrinsic value of the option and the extrinsic value of the option. The intrinsic value is calculated by taking the market price and subtracting the strike price. There will only be intrinsic value though if the market price is above the strike price. The extrinsic value is calculated by taking the option price and subtracting the intrinsic value. Essentially, the extrinsic value is the portion of the option value that factors in future changes in the stock price and the potential for the increase in value over time. An option with 1 week until expiration is likely to have more extrinsic value than an option that expires today, because there is more time available for the option to go up in value. Here's an example for you. If the stock price is $100, the strike price is $99.50, and the option price is 89 cents currently, here are the values. Intrinsic value equals $100 minus $99.50 equals 50 cents intrinsic value. Extrinsic value equals option price, 89 cents, subtracting the intrinsic value, 50 cents, equals 39 cents extrinsic value. In this example, the 39-cent extrinsic value represents the additional value in the option because there is still time available for the price to continue going up. As you get closer and closer to option expiration, this value will continue to go down until it reaches $0 at expiration. This is known as time decay. Extrinsic value is generally at its highest value the moment you sell the option. Okay, back to closing our covered call early. Ideally, we want the value of the option when we buy it back to be much lower than what we paid for it. For example, when I personally sell covered calls, I like to close them early for 10% of what they originally cost. This would equate to a 90% profit. So for example, if I initially sold a covered call for $1, my goal would be to buy it back for around 10 cents or less. Now, you do not have to always buy an option back early for a profit, and you don't always have to hold that option all the way until expiration. Every investor is different and everybody's goals are different. However, in some circumstances, it makes a lot of sense to buy the option back early for a large profit. Sometimes after you sell the option, the price goes down significantly in the stock, or it does nothing for a few days and the value of the option goes significantly down, in which case you might be able to buy it back early for a large profit way before expiration. And that allows you to then sell a new covered call for a much larger premium. When it comes to selling covered calls, there are a lot of different strategies out there. And these strategies are going to depend on what your specific goals are. The strategy for maximizing cash flow is going to be a different strategy than one that favors a balance between capital appreciation and cash flow. Generally though, when you're selling covered calls, most investors like to sell out of the money covered calls, meaning starting with a strike price above the current market price. This allows you as the investor to then participate in some of the capital appreciation in the stock price, but also get some cash flow as well. If there's other things you want to learn more about, any further questions you have, make sure to leave your 2 cents down in the comments below. It's my goal to respond to all comments left on the day I post a video. Also, if you want to learn more than what we talked about here, you can join the Average Joe Investor Patreon community. We now have nearly 400 members part of the community. Many of them sell covered calls, and it's a great community to be part of, to learn, to get your questions answered, to see what I'm doing in my portfolio and what others are doing as well. If you want to learn more about how to do that yourself, check out the link in the description below. That's all I got for you guys in this video. Have a great rest of your day, and thanks for watching.